everybody, Andy Smiles here. If you don't know me, I am the Andy behind andysmiles.com, which is a website and blog dedicated to all things self-employed finance. Now, I am here today to tell you all about buying a house and qualifying for a mortgage as a self-employed person. So here's the deal. I typically work in the business finance realm. If you've been following me for a while or you're in my Facebook group, then you 100% know that I talk about all things business finance. Qualifying for a mortgage is kind of one of those things that straddles more of the personal finance realm. But the reason I'm doing this live stream is because when I went this year to go, put in my mortgage applications and try to buy a house, I realized that the rules for self-employed people are so different, and there's a lot more planning you have to do around your business finances, your tax deductions, how much taxes you're going to pay, than if you were a W-2 employee. So this live stream is actually like a little bit out of my comfort zone when it comes to my expertise, but I still want to share this information with you. The other thing that I really want to point out is that I am not a home buying expert. I am really sharing my experience in a very real and true, raw way. I'm literally going to tell you the same things that I was telling my best friend over drinks. So this is not meant to be like, this is how you buy a house and all the legal details of that. This is really more meant to be like, this is what we went through. This is what we learned. This is what I would have done differently. And if you were my client and you came to me and said, hey, I want to buy a house in a year or two, what should I do now? I would tell you to do what I'm going to talk about today. So please don't take this as like home buying 101. There are other workshops for that, but this is more about my personal experience. So first things first, I just want you all to know we did successfully buy a house and qualify for the mortgage that we needed. So it is possible for self-employed people to buy houses and to get mortgages. I also want to point out that my personal situation is that my wife and I are both self-employed, which makes a huge difference because if you're with somebody, partnered with somebody, or buying a home with somebody who has W-2 income, a lot of what I'm going to talk about might not apply to you. But if you're like me and you are partnered with someone who's also self-employed, or maybe you're partnered with somebody and you are the primary financial provider in your relationship, and so really your mortgage qualification is going to be based off of your self-employment income, well, then you are also going to probably need to know this information. So just a little background about kind of like what happened and why we weren't prepared to buy a house. So basically, last year in September, my wife and I got married and had our wedding. And after our wedding, we kind of very loosely were like, okay, like we should probably think about this at some point, but let's talk about it next year. We're not really ready to buy a house. We're not really feeling like that's the thing we're going to do right now. We just finished our wedding. Oh my God, we don't want to plan anything else. So that's fine. 2 weeks after we got married, my dog went through the most bizarre, wild thing ever, and he stopped walking down the stairs of our apartment, which has 2 flights of stairs. Now, my dog is 70 pounds. I love him to death, but he will not be picked up. He refuses. He wouldn't walk down the stairs. He basically refused to leave our apartment. And this saga went on for almost 6 months. So what happened was that during this very, as you can imagine, extremely stressful time in our lives, having our dog be very ill. He was very ill for a while because he was walking down the stairs and he had all this anxiety. It was extremely stressful situation. But one of the things it brought to the forefront for my wife and I was this discussion of maybe we should accelerate our process around buying a house. So where we once thought, well, wait a few years, we kind of started to think, well, maybe this is sort of a sign that it's time to do this now. Maybe we should really seriously start looking and thinking about this. So we weren't really in the space where we were like, oh, in 2 years, we're going to buy a house, which actually a lot of you have been emailing me about this live stream and saying, yeah, we're 2 years out from wanting to buy a house. Like, I definitely need to know this information. We were not in that space at all. We were in the space of like, I guess we're going to like maybe try to do this right now. And okay, that's a little bit like unexpected. So what I'm saying here is that we really didn't do the planning, which is why we had so many problems and which is why If you're somebody who has the time to do the planning, I highly recommend you do the planning. If you're somebody like me, like somehow circumstantially, you don't have the time and space to do the planning and you just kind of find yourself in a situation where you're like moving forward in this process, then that's okay too. And I'll tell you a little bit about how we ended up getting our mortgage qualification without actually having done the proper planning. So let's fast forward to January. So in January, you know, we got our taxes done pretty early. We had our taxes done in February because we knew that we needed to do the home buying stuff, but we didn't actually file our taxes. So basically we had a tax appointment, our tax person did our taxes, did our entire return, and then we were waiting to file our taxes until we would do like a SEP IRA contribution. So we had everything and it was just like, once you do your contribution to your retirement account, then I will basically press send to the IRS. So we had a return prepared. We found an agent. Our agent recommended a mortgage guy. I'm going to talk about him a lot. So his name's Ed. So recommended Ed, and we met with Ed and we sent in all our numbers. And you know, when you work with a mortgage person, the very first thing they're going to do is they're going to run your information through like the most conventional loan programs. So there are different types of loan programs that you can qualify for. Most people who are W-2 employees just get what's called like a conventional mortgage. And that's just like, you send them some paid stubs, you send in some paid stubs and they like, run it through their like automated calculation system. And then they tell you how much you qualify for. That's like what a conventional mortgage looks like. So with conventional mortgages, what they base the information off of is 2 years of your tax returns. Right? So they're looking at filed tax returns. Now, this is an important point. So they're looking at 2 years of filed tax returns. So we were in 2019. We had not yet filed our 2018 tax return. So what they based our numbers off of was 2017 and 2016. Now, if you're self-employed, you know that your business can go from here to here in like 6 months to a year. So what I was earning in 2016 and what I was earning at the end of 2018, it was probably triple or quadruple what I was earning in 2016, which means basing my mortgage, my income off of 2016 dragged us down. We basically, when they ran those conventional mortgage numbers, I mean, we were like, we did not qualify for anything. We qualified, we had a qualification, but it was like not even near of what we would need to buy something where I live in the Bay Area. I mean, we probably could have bought like a parking spot, real talk, here in the Bay Area. And so we realized that one, we needed to deal with our taxes, and two, that any sort of growth spurt my business had gone through, especially because I knew in 2019 I was starting the year with like a lot of big contracts that would last throughout the year and beyond. None of that was going to get counted. So let's back up a little bit and talk about when you're self-employed, what they look for for your income numbers, because this is important. As self-employed people, we like to write a lot of stuff off, right? So we make some money, money comes into our business, and typically what we're doing is we're trying to find all of our tax deductions. Because what we want to do is we want to minimize the amount of taxes that we're paying, right? If you're a sole proprietor or a single member LLC, you are going to be paying your income taxes and also self-employment tax, which is 15.3% on most of your net profits. Just a reminder, profit is your gross income minus your expenses, aka tax deductions. What's left is your net income or your profits. So generally speaking, when you're self-employed, the practice is to write off a bunch of stuff, find all those deductions, get your home office in there, get your mileage, get everything you can into your tax deductions so you lower your tax liability. Awesome when it comes tax time and you don't have to pay as many taxes. Not so awesome when you're qualifying for a mortgage, because what they look for when you qualify for a mortgage, when you're applying for a mortgage, what they look for is your net income. They look at your taxable income. So they don't care what you made. They don't care about your gross income. And they don't care that you're like, well, I don't need to write all this stuff off. Like, you know, if I had to pay more for my mortgage, I probably wouldn't be writing off all this extra stuff. Or maybe at this point I wouldn't be investing big time in my business, right? They don't care about that. They look at that net income number. So that practice of trying to find all those tax deductions and really get your taxes down actually works against you. And the problem is that if you don't know that ahead of time and you are still writing a bunch of stuff off a year or two before you're trying to qualify for a mortgage, guess what's going to happen? They're going to look at that number on your tax returns and they're going to say, you don't make enough money to qualify. So this is an important thing to know. And this is also very important because it relates to like what we ended up having to do. So our first conventional qualification was like, forget about it. So then we went back to our mortgage guy and was like, here's the draft of our 2018 return and 2017, which we filed, right? Because this was, 2019. So we had 18 and 17. Please run the numbers and see if we can get anything better, which unfortunately we couldn't. So then what he said to do was he was like, okay, we can get you qualified for what you need. But what you have to do is you have to take I took out basically 90% of my business deductions. So 90% of my business deductions, we eliminated from my tax return. So what happens when you take out 90% of your business deductions? What happens is that your net income, your taxable income goes up, which means your taxes go up. And this is why I'm talking about planning in this live stream, because if you're somebody that's like, oh, I want to buy a house next year, so when I file my taxes in 2020 for 2019, I'm not going to write off as much stuff. Well, you're going to pay more taxes. So you need to be prepared. You need to financially be prepared to make these decisions and not be like us and make these decisions literally in March where we're like, oh shit, we're going to pay, I think our tax liability went up $6,000. That's a lot for your tax liability to go up, right? So it's a pretty big deal when you have to do something like that. So we gave that to our mortgage guy was like, this is what you need to take out for you to qualify. Because again, the problem is my income this year is equivalent to that. But they don't care about what I'm earning this year. They don't care about that. They only care about what's filed with the IRS and on paper. So what you are showing to the IRS, what you're showing to the mortgage people is what's being filed with the IRS. That's what they're going to go off of. So even if this year you ended up with like $100,000 contract and you're like, I'm rolling in it now, like I'm all good. They don't care. They need to see that filed on a tax return. So then we did all this and we took everything out and we still couldn't get what we needed because 2017, we took a lot of big deductions and we were dragging down my income. So basically 2017, because of all the deductions we took, we were just dragging it down, which means that the problem was that we had to figure out a way to make 2017 go away, right? Because 2017 was the thing that was really hurting us. And 2017 was like making our average income like $20,000 or $30,000 less. And that's a pretty big deal when you're trying to qualify for a mortgage. It's like a lot of money to not be showing that you earn when you're qualifying for a mortgage. So then the next thing that happened is our mortgage guy was like, okay, here's what I'm going to do. I'm going to see if we can do a bank statement program. So this is a mortgage program that a lot of self-employed people tend to use when they're trying to qualify for a mortgage and they're having the same problems that we had, which is basically that they filed their tax returns a couple years ago, they took a ton of deductions, and now their net income is too low for the mortgage to go through. So what a bank statement program is that you submit 24 months of bank statements to your mortgage lender, and they go through the statements and they basically look to see, they look at your cash flow. So they look at your cash flow, they analyze your inflow, they analyze your business expenses and your outflow, and then they analyze like what's personal, what's being transferred to savings, what's being, they kind of analyze all that. I couldn't really get too many specifics about what was being analyzed when I asked, but basically it's more of like a cash flow analysis than it is like an income and expense analysis. So we submitted our bank statements, and the good news was through the bank statement program, we did qualify for what we needed, which was awesome. But the bad news was that through the bank statement program, there was a higher interest rate. So when you go through any sort of special program that isn't a conventional mortgage, you're probably going to pay a higher interest rate. It might not always happen, so I don't want to say like you will always pay a higher interest rate, but a lot of times you will pay a higher interest rate. So you want to be aware of that, because if you're sitting here thinking, I don't want to do all this like tax planning, I just want to buy a house next year and like go through a special program, I will tell you that it is probably not going to be worth it with the interest rate difference. So for us, trying to go through the conventional mortgage, at this point, this was before the interest rates got cut. So at this point, a conventional mortgage interest rate was around like 4.25% and 4.5%. What we got quoted, the lowest that we got quoted was 6.75% going through a bank statement program, which was way too much. And we were like, we are not, especially because we both have pretty good credit, we were both like, we're not doing that. Like, that's ridiculous. Like, sorry, but no, thank you. And even our mortgage guy was like, don't do this. That is unbelievable. But that's the thing. You may hear about, oh, there are these special programs out there for self-employed people, and like, even if your taxes aren't the way you need it to be, you'll be okay. But what people don't tell you is that those special programs cost a lot of money to be a part of. So don't just think that a special program is going to be the thing that gets you qualified for a mortgage, because that's what we thought. And we just walked away from that. So basically what then happened is that we gave up for about 3 months. We were like, you know what, forget this. We'll just wait until next year. We will, file our taxes next year early. And then because we knew that my income this year would be as much, if not more, than the 2018 income with all the deductions removed. We were like, forget it. We're just going to like wait until next year, do a conventional loan program. We're good. And then what happened is that our mortgage guy basically went independent, which meant that he was once working under a mortgage company, so he could only go with the rates that they would like offer him and the investors that they were linked to. He then went independent, which meant that he could just find us whatever program was best for us. So after about 3 months, he reached back out to us and said, hey, look, I'm independent now. I think I can get you a better rate. Let's try a new program that I can now try to get you into, which is a 1-year tax return program. So a lot of times when you're trying to qualify for a mortgage, especially if you're self-employed, they want to see 2 years of business income, because basically the people who are loaning you money want to make sure that you can like pay it back, right? So what they need to know is that your business is solvent and sustainable. Some companies won't even loan to you if you've been self-employed for less than 2 years. It really depends. Like sometimes people won't loan to you if you've been self-employed for less than 2 years. Sometimes they'll make like exceptions or have special programs, blah, blah, blah. But basically, usually the case is that they want to see 2 years of business income and expenses, right? They want to see that your business has been around, that people are going to hire you, that you are like legitly out there. So this 1-year program was interesting, and we knew that with the 1 year, the 2018 return, that we would qualify for what we needed, because we had our mortgage person had done all the numbers to tell us what the income needed to be to qualify. So we said, okay, let's just run the numbers, see if you can get anything. But we were pretty like, well, whatever, like this isn't going to work, And it turned out that this program, whoever he found to finance it, the interest rate was the same that it would have been on a conventional loan. So we didn't end up like having to pay the price in our interest rate, which was happening before. And that was how we ended up getting the qualification for the mortgage, is we went through what's called a 1-year tax return program, where basically they base your income and your income and your qualification based on 1 year of tax returns. Now, a lot of these programs, even though they're basing things on like 1 year of tax returns, we still had to submit like bank statements from our business to show that our business actually like makes money. I think we even submitted like current bank statements to show that our business was like continuing to make money. Like all of our 2009 statements, like, yes, we continue to like have a business that like earns money. We also had to submit like proof of assets, which I think you probably have to do anytime you do a mortgage, but like I just know for sure that we had to submit like a lot of proof of funds that we could afford, like the down payment that we said that were going to do and our closing costs and all of that stuff. So it wasn't just like, oh, here's a tax return, blah, blah, blah. There was more things that went into it. But ultimately, that's how we ended up qualifying for the mortgage. So it was a very long process. And the things that I learned throughout this process, which is really like the key takeaway here for you, is that you really need to plan your taxes. So even if you're thinking, okay, we're in 2019 right now, and let's say you think, okay, I want to buy a house in 2021. Well, next year, when you file your taxes, you need to already be planning for 2021. Because next year, when you file your taxes for 2019, that's one of the tax returns that are going to count towards your qualification. And then when you file your taxes for 2020, that's another tax return that's going to count for your qualification. So in an ideal scenario, I believe after this experience that self-employed people need to plan 2 years in advance, like 2 tax returns in advance. So that might mean like maybe you didn't know maybe you weren't thinking about buying a house until like now. So you've been like spending money in your business, right? And you're like, I'm gonna write all this off. Oops, now I think I want to buy a house soon. That means that when you file your return, you may have to take out some of those deductions, which is fine. The IRS does not require you to report all your tax deductions. They're like, I don't care. If you don't report them, they just get more money. You can take out as many deductions as you want, right? Like you can do that, but the other part, like, so you need to plan what income you're going to show, but the other side of that is that you need to be prepared to pay more on your taxes. So if you've been thinking, oh, I'm just going to like, I know how much I'm going to pay on my taxes. I'm aware of how much it's going to be because I've been like calculating it. And now you're going to be taking out deductions in order to get the numbers you need to qualify for a mortgage. You need to plan that side of it, of what the increase in your tax bill is going to be. And you want to be sure that if you really are going to, pump up your numbers on your tax return to get a mortgage qualification, that you also have the cash to pay for the increased tax bill, right? So that's that piece. That's the other piece of it, is planning what is the income you need to show, and then also planning how much are my taxes going to increase, and will I have the money to pay for that increase in taxes? So that's number one. You need to plan there. Now, what if you want to buy a house next year, right? What if you thought, oh gosh, I didn't realize I had to plan 2 years in advance and I was planning on doing this next year, or you're just circumstantially things are changing and that's kind of like where you're at right now. It's the same thing. You're still going to have to really think carefully about what you're reporting on your tax return next year. And my recommendation, because I've been talking to a lot of self-employed friends about this who are like, oh yeah, we're thinking about buying a house in a year or two. I think you should go talk to a mortgage person now. Go find a mortgage broker or a mortgage lender or whatever, whoever you want to work with. My guy was great. He works all over the US. So if you want his information, you just DM me and I'll send it to you, because he really knew how to deal with like self-employed people and he was really good at problem solving that. but whatever, like, or you might have your own recommendation, whatever. But the point is that you should go now and talk to a mortgage broker about what amount, how much income you need to qualify for a mortgage for a home in your area. Now, I live in the Bay Area. It's like one of the most expensive housing markets. So obviously, like for us, we needed a lot. But depending on where you live, maybe what you earn right is totally fine, or you need to bump up your numbers. But before you get into the taxes, talk to a mortgage broker, talk to a mortgage person, talk to somebody who can say to you, like, tell them what you're looking at. They can say to you, okay, in your area, if you want a house that's going to cost $400,000 and you have, X amount down, you need to show that you can qualify for, I don't know, $350,000. This is the amount of income that you need to show in order to qualify for that amount. Because that's kind of like what you need to know when you're doing your tax planning. And then you can sort of decide, can I qualify for that this year with my previous year tax return? Do I need to try to do a 1 year? Do I need to wait a year and just keep planning? Those are all these decisions that you'll have to make. But if you think, like, what I basically learned is that W-2 employees, because usually they just have like steady income and their income is kind of like consistent, it probably just goes up because they get raises. Like W-2 employees don't have to do this like extent of planning. It's nice in a way to be self-employed and be dealing with this stuff because we do have the option of taking deductions out of our tax return. It might even just be something like you just don't claim your home office 1 year. And that taking that home office deduction out is enough to get you to qualify, right? Like at least we have that flexibility, which is actually really, really cool. But it also means that we need to think a little bit more like carefully about the process. So my two main recommendations are to, start planning. If you're 1 or 2 years out, start planning now, like right now. And two, to talk to a mortgage person now. Like, seriously, like, if you're 1 or 2 years out, you might be thinking, oh, but then I feel bad because, like, I'm not going to work with them for 2 years, whatever. No, like, just go find somebody, find out what you need to show on your tax return, and then what you can do is, like, then you're going to talk to your tax person, and your tax person is going to help you figure out, either am I going to show it just with what's true, or do I have to like kind of take out deductions, especially considering what you filed last year on your taxes, right? Because I would recommend trying to just get a conventional mortgage and not trying to do a special program because the interest rates are so much higher. So in that case, you really want to plan, and this little bit of work that you're going to do now is going to save you a lot of money in the future, because even like 1% difference in interest rate saves you tens and tens of thousands of dollars, depending on the price of your mortgage, right? So it might be a little bit more right now to deal with, but it's really worth it to put in the legroom now so that you save money. And that is everything that I have to say about getting a mortgage as a self-employed person. So thanks you all for watching. I've had a lot of people email me and message me about putting up a replay because they can't watch live. So there will be a replay. I will send it out to my email list, the link, probably next week. But there will definitely be a replay. So if you, if you missed half of it, if you showed up late, if you're like, I don't know what she's talking about, but sounds kind of interesting, be sure you're part of my email list. And you'll get the replay link. If you're not on my email list and you're on Instagram, you can message me and I will tell you how to sign up. If you're on Facebook, you can comment below and I will tell you how to sign up. And thanks everybody for watching. Let's see if I can simultaneously end